Okay, welcome everyone to Module 1 of Business Basics for Beginners, where we're going to look at accounting first, and then from there we'll look at finance. So financial literacy. Yes, you have an accountant, but as Robert Kiyosaki says, and if you don't know who he is, he wrote the book Rich Dad Poor Dad. Accounting is possibly the most confusing, boring subject in the world, but if you want to be rich, it could be the most important. And of course, this is about business ownership and business management. He also says, if you want to be rich, you've got to read and understand the numbers. So if you read in his book, as well as some other literature, and I'll paraphrase with my own words, when you're a business owner, you need to be able to understand your balance sheet, your income statement, regardless of what your profession or trade is, regardless of the fact that you will have professional accountants that you can work with. You need to be able to look at those and have an understanding of what you're reading. So that's what we're going to do today. So the two most important financial statements in your business are the balance sheet and the income statement. The balance sheet shows what we own and what we owe. And you'll see that difference in a second. The income statement is what we have earned and what we have spent. And hopefully there's a bottom line there. The simplest way to illustrate a balance sheet for me is to talk about something that's personal, not business. In this example, if you own a house, it's an asset, and it's worth $500,000, that's the fair market value of the house today, not necessarily what you paid for it, what it is worth today, then you have $500,000 in assets. But if you still owe the bank liability, mortgage, $400,000, that means your equity is $100,000. Now, the way a balance sheet is written is they've got your assets on one side, your liabilities and your equities on the other side. And the two are in balance. But the real equation is assets minus liabilities equals equity. That's the simplest way to look at it. $500,000 house, $400,000 mortgage, 500 minus 400 is 100. That is the accounting equation. Unfortunately, it's not laid out in that manner on a balance sheet. This is how it's laid out. Assets on the left, liability and equity on the right. So let's expand that. Let's say I have $1,000 in cash, as well as my house. And I have a car that's worth $25,000. Now that may not be what I paid for it, but it's what it is worth today. Now I have $526,000 in assets. On the other side, I've added the car loan to the mortgage. Now typically these are separate lines, but that's okay. We're trying to illustrate here. So the liability is your mortgage of $400,000, your car loan, you still owe the bank $20,000. That means now your equity is $106, because your assets minus your liabilities equals your equity. And you can see in this example how that's changed. It was $100,000 before. We added $1,000 here, plus we have a $25,000 car, which I didn't explain. That's the extra 20. That's the bank loan. That's how much you owe on it. So you put $5,000 down, and you owe 20. That's how we came up with 106. Okay? How's that so far?
I think it's so far.
All right. Oh, there we go. All right, now let's look at it from a business example. We looked at a personal example. And yeah, you could do up a personal balance sheet if you want to. Let's look at a business example. This company has $100,000 in cash, $10,000 in inventory, and we'll talk about inventory in a few moments, but essentially it's stuff that you've bought that you're going to resell to customers, but you haven't sold it yet. You still have it in your store. Capital assets, and again, we'll get to those. But in summary, those are your buildings, your equipment, and a few other things. They're assets that you own, that you use for business, but you haven't used them all up yet, so they're still showing as an asset. And we'll get to that. This comes to $1,110,000. Now, under the liability section, the loans or payables, $800,000. Now, these are just arbitrary numbers that I've put in, okay? So this $800,000 could be a combination of a mortgage against these assets, and it could be an account payable because you bought this inventory but haven't paid your vendor yet. Again, all of these things we're going to cover as we go through this today. This leaves us with an equity of $310,000. We've added up our assets, we have subtracted our liabilities, that gives us our equity. So that's what a balance sheet looks like, a simple one, for a business. Any questions? We're good? Okay. Income statement. That's the second one. This is what we've earned and what we spent. So in this case, we have earned revenue of $100,000. That means we have sold $100,000 in goods or services or a combination of the two to our customers. Cost of goods sold in this case is $50,000. What that is what did it cost us to buy the things that we sold? So we talked about inventory in the previous example. If you're for example, you're a hardware store, you buy all the nuts and bolts and lumber and paint and everything that you bought, that's inventory. It sits on your shelf, it's an asset, till you sell it. When you sell it, you have revenue, you need to take what you sold out of the inventory, put it on your financial statement, your income statement, as a cost of goods sold, and that's how it works. Now the next line is general expenses, $30,000. That could be a combination of rent, utilities, salaries, benefits to employees. There's lots of things that could be included. The net income in this example, this simple example, is $20,000. $100,000 in sales, minus $50,000 in cost of goods sold, minus $30,000 in general operating expenses, gave us a net income of $20,000. All right? Now, let's put these two together. So in this example, I start with the balance sheet up top, and then I have the income statement below. And again, these are simplified examples. We have cash of $125,000. Accounts receivable of $20,000. What's that? Well, we had sales to customers, but they haven't paid us for them yet. Account receivable, it's an asset. That money's owed to us. Inventory, we still have $5,000 left in inventory. Capital assets, our buildings, our equipment, our vehicles, gave us the $1.150 million that we talked about a few minutes ago. But now, you'll see on the other side, $800,000 in loans and payables, $330,000 in equity, but I've added a line now. It's called current income, $20,000. Gives us a total equity and liability of $1,150,000. Those two are in balance. Where did that $20,000 come from?
The net income?
Exactly. Perfect. It came from here. This number feeds into this document, so your net income feeds into your balance sheet in your equity section and puts everything back in balance. If you had a $5 sale right now, cash, this would go to $125,005. This would go to $1,150,005. This would go to $100,005. This would go to $20,005. That $5 would be added here, which would now put this into balance. This brings us to a very important point. Everything you do has two sides to it. If you get cash for sales, there are two entries. One is putting an entry into your bank account, and the other is putting an entry onto your income statement for revenue. Always two entries. Everything we do. That's what we call double entry account. Always two sides to it. So which statement do you think is the most important to us as a business owner or manager? Now, managers might see it a little bit differently depending on what responsibilities are put on them. But if you were a business owner, which do you think would be the most important for you?
The income statement.
Okay. What do you think?
The same.
Okay. A lot of people want to run to that income statement. How about both? Sorry, wrong direction here. I'll tell you why both. Both are important, equally important, and you have to look at them together. Here's the thing. The equity is what you are worth, what your business is worth. What have you accumulated for wealth? You ever see on the internet they say so-and-so's net worth is? That's what they're talking about. How much money are they worth? Who cares what they have in assets? Because there may be a ton of liabilities against them. Their net worth may be nothing. But your net worth is what's important here. But your income statement feeds into this. If this is zero, your bottom line is zero, you're not going to be improving your equity. The chances are. Now you may have some assets that grow in value somewhere else, but that growing is still revenue to you. When something becomes worth more money, in the long run, it's still revenue. Now how it's recorded would be a little bit different than actually doing sales. But at the end of the day, we need to look at both. Okay?